All right, I'm going to talk about estimated market value using capitalization rates. Last time we talked about estimated market value using the CMA, or comparative market analysis, which is the first approach that you can use, but not all properties fit into that. So we're going to learn how to do use capitalization rates to estimate market value. But first, what is a cap rate or capitalization rates? Well, it's the rate of return on investment property that is expected to generate. So just like you would look at your ROI for any investment, you want to see your rate of return for your stock portfolio. The cap rate is your expected rate of return on your investment property. It's a very simple formula as well. Just the NOI, or net operating income, divided by market value is your cap rate. Now, just to cover it real quick, the NOI is your income, your total rents, minus your total expenses. Now, your total expenses does not include the principal and interest paid on a mortgage. So it's your total expenses except for debt service. So it will still include insurance and taxes, maintenance, trash removal, pest fees, whatever you have to pay in order to maintain this property. But it does not include the principal and interest portion of any mortgage that you're paying. So it's your gross rents minus all of your expenses. And that is your cap rate. So real quick, if you have a $120,000 property that has NOI of $10,000 per year, that'll be a cap rate of 8.3%. So basically, if you're looking at a property and, or just say a recently sold property in an area sold for $120,000 and NOI was $10,000, you can say that was an 8.3 cap property. So let's look at another example. We want to estimate the market value of a property. So you would do this to try to guess or plan your offer, basically. So two pieces of information you might have is what the property is earning, its NOI, and what other properties cap rates were in recent sales in that city or area. So if you can have those two pieces of information, you can calculate what your maximum offer should be. So in this example, let's say a property is earning $25,000 per year and the local market has a cap rate of 6%. That means most properties are earning a 6% rate of return on the investment. So you have to adjust the formula and solve for market value, which should give you the NOI divided by the cap rate will equal your market value. It's a slight adjustment, but the same formula. $25,000 divided by 0.06 is $417,000. So if you wanted to earn a 6% rate of return and it was returning $25,000, you would offer $417,000 on this property. Now you could take it a step further. That's your final price. You want to get a good deal, so you offer less than that. Also, if there's any deferred maintenance or other expenses, you'll want to subtract those out as well. So if there was $40,000 in work that needed to be done to bring the property up to value, or bring the property up to the correct condition, maybe just code violations or other damage that needs to be fixed, you might subtract that out as well. Now, you can see with cap rates that there's a couple ways to earn some more money or increase the value of the property. You can see by reducing your costs or increasing your income, it's going to increase the value of the property. So if you could raise rents, instead of earning $25,000 a year, you could earn $30,000 a year, you can see that the property value goes up. Now this is different from a typical residential property, because if you raise the rents on a residential property, like a single family, the market value of that single family is not going to go up. Now, if you do some improvements, the market value can go up. But just raising the rent will not increase the value of a single family home. But for commercial property or very large residential properties, raising the rent across the board and increasing your NOI will increase the value of that property. And that's an important distinction when using these two.